I'm Pattu from freefincal. Today let's talk about a counterintuitive buy high, sell low kind of market timing strategy that surprisingly works. This strategy is identical to the one that I talked about with regard to gold, a momentum timing strategy. A couple of days ago, some of you had complained that they didn't understand what I had talked about. Maybe I'll try and do better this time. So again, the strategy involves taking the Sensex price data and plotting the 12-month moving average. The Sensex price data is in blue. The 12-month moving average is in red. The 6-month moving average is in green. So what you do is you take monthly data of the Sensex and you plot the average of the last 12 months and the last 6 months, and you get those graphs. And every time the 6-month moving average, that is the green line, is above the 12-month moving average, the red line, green line is above the red line, you go all in to equity. That is, you buy 100% equity. Your tactical asset allocation has got 100% equity. Your future investments are also into equity. When the green line falls below the red line, that is, you have this dotted line here. When the dotted line is 1, that means that the green line is above the red line. When the dotted line jumps to 0, that means the green line has fallen below the red line. And when the dotted line is 0, you are all into cash. And in this case, I use gilts, but cash also is fine. In this case, I use gilts. And you're all into cash. And as long as the green line is below the red line, you continue buying gilts. And this kind of strategy I backtested from 1996 over 10-year periods. So this backtest means that the first test runs from August 1997 to August 2007. That's the first date. And then you start the second run from September 1997 to September 2007. The third run from October 1997 to October 2007, and so on and so on and so on until you end up with the last runs being from May 2010 to May 2010 to May 2020. So that is about 155 data points, and this strategy got a better return for 150 out of 155 times. So if you look at the results on the top left of your screen, this one, you can see the mouse circling. The strategy, that's the tactical asset allocation XIRR is shown in red. The systematic XIRR, that is, you invest 50% in equity, you invest 50% in gilts, rebalance annually, and that's shown is in blue line. For most of the cases, the return for the tactical has been better. Onto this graph here on the top right, this is the maximum drawdown. That is the maximum the portfolio will fall from a peak. And this has been much higher, almost twice as high for the tactical strategy than the systematic strategy. This means that this tactical asset allocation is high risk, high reward strategy. And on the bottom left, you have the standard deviation, that is the monthly volatility. And naturally for the tactical, the volatility is higher. And on the bottom right, you have the continuous number of months for which the portfolio was below a peak. And you can see that for the tactical, it's been the case for 20, 25, or even sometimes 30 months, whereas it's significantly lower for the systematic strategy. So the systematic strategy comparatively is a low risk, low reward strategy, or the other way is to say the tactical is high risk, high reward. Now the worst case for the tactical strategy, or the only instance that the tactical strategy did not beat the systematic strategy, is in April 2020 and May 2020 after the crash. And that's what you can see here. After the crash, the tactical strategy fell much below the systematic strategy, but before that it was doing well. So that's a risk that you kind of have to take. Of course, it would be wrong to dismiss this strategy because of its single failure here, or it is wrong to say this is a great strategy because we have to test more. So one of the many additional tests that's possible is to take the S&P 500. I've incorrectly labeled it as Sensex. Sorry, it's S&P 500. And again, here I have plotted the 12 months moving average and 6 months moving average of the S&P 500, and again I have plotted the indicator. So here again, if you do back tests, in the case of 10 years you can do 1336 back tests. Out of those 1336, 90% of the back tests, the XIRR for the tactical was higher, which is quite astounding. And again, of course, the risk is higher for the tactical, but that's acceptable. If you go over to 15-year back tests, which is possible because you have so much data, because you're actually testing the S&P 500 right from January 1900 onwards. 1st January 1900 is the date Excel shows as 0. So that's from that date onwards we are testing it, and that gives you 1276 15-year data points, and astounding 99% of the times this strategy has given a more return. Of course, it has given you, along with more returns, it has given you additional high risk as well. So that's a gamble that you can take, and that's something that you can choose to do. In the case of S&P 500, I must point out that I have taken a cash instead of gilts, and I have taken the median return, monthly return of 0.23% for the 1-year treasury gilts from 1962 to 2019 onwards. That's the median monthly return. I don't have data all the way up to 1900, so I took this, but still it's a very interesting result. So the next step is to find out if this strategy will work with gilts and cash, and then as a final step we're going to do a 4 portfolio market timing. We're going to have cash, we're going to have gilts, we're going to have equity, we're going to have gold, and we're going to time the market simultaneously with this kind of 6 months versus 12-month moving average timer, and find out how this fares. So let's see how that works out. Hope you were able to understand this a little bit better. If you have any questions, please let me know. I am working on the rebalancing post. I will bring out a video on that shortly. Thank you. Bye-bye.